Changes are always good as long as those changes will lead to investment growth, especially for ETF or stocks or anything that we invest our money into. And these are the changes that recently that Hamilton ETF has just made to one of their ETFs. I recently made a video about Hamilton brand new ETFs. So with this new brand new ETF that just created, now they have more leeway to transform all the existing ETF to more in a house type, and this will reduce costs and will better our performance of these ETFs. That's the theory, and that's what we are expecting, or the managers of Hamilton ETFs are expecting. Before we go to what changes has made, we just look at the Hamilton Enhanced Multi-Sector Cover Call ETF, which is a HDIV. You can see 52-week range has ranged between $14 to $16.36. So that's a pretty good. We can see it's not when it came at $16 when it was incepted, it hasn't really gone down as much. You know, you can see right now it's 1587, so it's pretty good. But you might say, well, it's down from where it was, but actually it's not. It hasn't been down because it does yield about 1059. And when we go to actual website, I'll show you the performance, how much it has done over the years, because this came it was incepted in July 19, 2021, so it's been around for a year, and they do pay monthly dividends, and right now it yields almost 11%. So imagine you get that 11% dividends. So you haven't lost any money pretty much if you invested in this ETF from inception. If we come to official website, we can see Hamilton ETF, Hamilton Enhanced Multi-Sector Cover Call ETF, delivering you more income every month. So I've talked a lot about HDIV. I made a few videos and comparing HDIV and other ETFs. So today I'm just going to go a little brief on this one, and then I'm just going to show you the changes that they've made, right? So if we look at the highlight of this ETF, HDIV has outperformed the S&P TSX 60 by 3% annualized since inception. So TSX is the Canadian market, right? You know, so pretty much like S&P 500, but this is specific Canada market. So 60 biggest companies in Canada. Yield right now is 1085, and which pays monthly, and portfolio of primarily sector cover call ETF with sector mix of broadly similar to the S&P TSX 60, which is you know, Canadian market. But actually this is kind of deceiving because it's not really TSX. As you can see, it does not really represent TSX 60, because TSX 60 is more of a just Canadian markets, but this one has more than Canadian market. It's pretty much US. Modest cash leverage of 25%, so they do have leverage to enhance that yield. You know, as they say here, enhance the multi-sector, because they enhance that using the word here, enhanced, meaning they enhanced the dividend using that leverage right there. So who is a good investor? Who is an investor who is this ETF will be good for them? This ETF will be good for any investor who is looking for monthly income, investor who is looking to diversify their portfolio similar to the S&P 500, TSX 60, an investor who wants to increase growth potential of their portfolio. You know, instead of using individual stock, they use you know, just one ETF rather than buying a bunch of ETFs. And person who's looking for high yield alternative, alternative versus broad index ETF, right? Because the broader index ETF, for example, VCN, does give you only 3 to 2%, but this one would give you 1085, but also you get a broader diversification. And fund objective is to, you know, provide attractive monthly income and long-term capital appreciation from diversified multi-sector portfolio of primarily covered call ETF focused on Canada. Again, I would repeat this. This is really deceiving. It's not really only focused on Canada. As we can see, the portfolio has changed and they need to change this. It's really not only Canada, right? So, you know, this is deceiving. And I can tell that. This is my criticism of these Hamilton ETFs. They really need to change, because right now HDIV does not represent Canada. I'll show you why. All right, so if we go down here, we can see performance. Ticker symbol HDIV has outperformed since inception has returned 8.99. So since inception, meaning it has returned 8 annually, right? So you can see here year to date is down, but we look at the bigger number right now. Here is 8.99. This is what you care about. Within 1 year has returned 6%. Within 3 months has returned about 3.70%. 3 months has returned 12%. But all these numbers, you always look at since inception, how much has returned. If you look at that little dot right there, annualized annual return of 8.99, so about 90%. This is a pretty good. If we look at this is performance is compared to the Toronto Stock Exchange or Canadian stock market. It has the red one is HDIV, and the TSX 60 is down here on a gray. You can see this one here is way up, and we can see dividend is compared to regular TSX 60 broader ETF. The broader ETF only pays about like a 3%. This one pays about 10.82, so it's a pretty higher yield. So this will be really great than investing in a broader market, because you're getting higher yield and your performance is greater. We look at the distribution overview of this one. Before we go to overview, we can look here at distribution. Last time they did pay 15 cents. We can see they have increased, because it was 14, but we can see they have actually increased. If we look at the history, it was 12, it was 13, it went 14. So they do increase dividend, which is a pretty good, and right now it's about 15 cents. So pretty good. And that this is coming, this is the coming dividend that they just announced, so that's a good. So let's go continue to overview. Again, if it's your first time, just make sure you subscribe on the channel, and if you like my content, just make sure you smash the like button, because on this channel I always bring this type of update and changes whenever that happens. We look at the sector allocation, right? It's financial is 33%, utility is 15.8%, healthcare is 11%, technology is 16% right now, gold is 9.7%, and energy is about 14.7%. So it's a pretty diversified when it comes to different sectors, and I like that they have healthcare and they have technology. If we look at the holdings now, and that's what I told you guys. Before we look at this holding here, let's look at the inception. Pretty much, we look at the management right now. Management fee right now is 0 because it's fund of funds. So underlying ETFs, you paying these underlying ETFs here, you are paying fee on these ones, but on this HDIV itself, you don't pay fee. So that's why they say it's 0%. But end of the day, you do pay fee, because you don't pay directly, so you pay indirectly. So again, that 0 fee is kind of deceiving again. When it comes to risk of this is medium. When it comes to asset under management right now is almost 400 million. So pretty, it's growing for what it is, and current yield is 10.85. So we look at this one. This is, as I said, this fund right now has changed massively, and because of this change, it doesn't make it Canada focus anymore, because we look at this Hamilton Enhanced Canadian Financial. Yes, it's Canadian. We look at the QMAX, Hamilton Technology Yield Maximizer. Check my other video, I talk about QMAX. If you look at the QMAX, majority of all these stocks except Shopify, everything else is US stock, because as you know, all the technology, the US stock, there are 20 of them. We look at the Hamilton Canadian Financial. Yes, that's Canada. We look at EMAX, Hamilton Energy. It's pretty much Canada, but it does have US too. When we look at LMAX, Hamilton Healthcare, they're all Pfizer's and Johnson & Johnson. So there's really nothing Canada in there. We look at the AMAX, Hamilton Gold Producer. This is a blend mix. Hamilton Enhanced Utility is 6%. If we compare this, let me show you, before these ETFs, there were some other ETFs that they had, but that has changed. Look, this is what it used to be. Used to have CIA Energy Giant Cover Call ETF, HFIN, Hamilton Enhanced Canadian Financials. It used to have Horizon Gold Producer, BMO Cover Call ETF, which is ZWU. It did have Harvesty Healthcare Leaders. This also includes some US companies. Harvest Tech achieve growth and income. Yes, companies as well was over 10%. But right now, the tech right now is represent about 16% versus here it was only 10%. And you'd had HMAX, which is Hamilton Canadian Financial, so that has increased a little bit from 9% to more than 9%. And they had ZWB, which is BMO cover call Canadian Bank ETF. So you can see there's pretty much focus more on a lot of Canadian and US wasn't as much, but now they have changed and they've made more, more of these US big focus. For example, if we look at healthcare, it's a huge, right? Most of the US companies, and of course, QMax technology is 20%. That's huge. So all in all, this really doesn't matter. What matters is performance, and you get the dividend, and you don't have to worry too much about the actually tax implication, because everything is going to be included in your MER, management expense ratio. So for people who wants to have a broader diversification of ETF that does well in terms of performance and has a greater yield, this is the perfect choice for you. So that's all for today. I just want to give you an update on the Hamilton Enhanced Multi-Sector ETF, which is HDIV. Again, if it's your first time, just make sure you subscribe. And if you like this content, just give me a smash. Bye bye.